Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Karl-Heinz Laschnicht. Hope I got it somewhat right. Anyway, Karl-Heinz, that's a name, is an attorney at the Silicon Valley Law Group here in San Jose. He has worked with that firm since 2007, has a total of about 12 years of experience as an attorney, and he received his JD, or Juris Doctorate, from Santa Clara University in 1999. He works in the area of corporations, mergers, acquisitions, and finance. Previously, Carl worked for 6 years in public accounting, so sort of got his basics to understand how businesses work inside of CPA firms. So Carl, thank you for joining me as the guest today.
Thank you for having me.
Okay, Karl-Heinz.
Karl-Heinz, I'll remind you.
Okay. So today, Karl-Heinz and I are going to be talking about the choice of form for doing a business. And as we do that, I just want to caution you that we're only covering some highlights of an enormous area of the tax law and other areas of the law, and rules relating to choosing the form of doing a business. It's a bare starting point to learn about some issues, and we want you to get qualified tax and legal advice. This discussion is going to focus on California law. Karl-Heinz is a California attorney. I am a California CPA. The rules will vary somewhat for other states, and so please be aware of that, and again, get some local advice. Okay, well, let's get into some questions.
Okay.
All right. So, when you're starting a business, a lot of people think, well, I guess I should incorporate. Is that usually the best choice?
Maybe, maybe not. Mm-hmm. It depends. There are many different types of entities. I know you're aware of that. There are corporations, and within the California Corporations Code, there's no distinction between what we know as S corporations or C corporations from a tax perspective. There are also limited liability companies. There are limited partnerships, general partnerships, and sole proprietorship. Mm-hmm. So what ends up happening, the client comes in with an idea of maybe I should be a corporation, mm-hmm. and we will walk through the steps of what makes sense for their particular situation. For example, I would say a corporation, a C corporation, I believe has a limited use given the flexibility of all the other entity structures. The main reason is a C corporation, as you very well know, has a double tax, which means that the corporation gets taxed, and then the individuals, upon receiving distributions, will receive those distributions subject to tax. Mm-hmm. We can probably cover that a little bit more later.
Yeah, and when you're first getting started, maybe more importantly, the corporation may incur losses for which it can't get a tax benefit, whereas if it was doing business maybe with one of the other forms, those losses could actually be passed out to the owners, and they could use them on their own income tax returns.
That's right. It's a good point. I've had a situation where I have many startup clients, and the startup clients, we will structure them, for example, as an S corporation, assuming they meet some of the requirements. Mm-hmm. And those losses are able to they'll flow mm-hmm. through to the individuals.
Right.
And when we got to the point of break even and making a profit, they terminated the S election, became a C corporation.
Right.
And then also went out and sought funding, but that's a different situation.
Another area.
Yes.
Okay, well, we've thrown out these little terms, C corporation, S corporation. So what is a C corporation? What is an S corporation? What are they best suited for?
Well, the two types of corporations, again, the distinction, I call it a tax distinction versus the California Corporations Code. Mm-hmm. The C corporation, well, first let me start out with C corporation or S corporation is a separate legal entity, separate and apart from its owners. A corporation has, much like we do as individuals, has a birth, a life, and eventually will have a death at some point, not necessarily. The structures of a corporation, they're very formal. So let me just share a little bit of that, and then we'll get into the distinction.
Okay, go ahead.
So for example, a corporation is very formal, it's very easy to set up, but the shareholders, also known as the owners, will elect directors on a yearly basis typically. Those directors set policies and procedures, and those directors will then elect the officers. The officers then run the day-to-day business. Now, this will come to play when we discuss the other types of entities, how you can see it becomes a little cumbersome. Yeah. Every year that you have to go through this process, and every year we have to have board meetings and shareholder meetings and minutes and so forth. And as we'll see later, we have some flexibility in other types of entities. An S corporation also has that structure as well. They don't get away from that. But what the S corporation does that's unique to the system, so to speak, compared to the C corporation, is that the S corporation has what's called flow-through taxation, which means that the entity itself, for federal purposes, does not get taxed, and the income is attributed to the owners pro rata based on their ownership, and the individuals pick up the income or loss on their individual tax returns. Those are the main differences between the two. Let me go on as far as what makes sense for one type versus another type as far as business. So for example, an S corporation is limited, I believe, by not necessarily the number of owners. You're limited to 100 shareholders. A lot of startup companies or companies that are forming don't have that problem. But when they start getting into questions of meeting the formalities are the types of shareholders. Very limited. You must be either an individual or certain types of trusts can hold stock in an S corporation. There's also another key aspect, which is you may only have one class of stock. Now, typically that's going to be a voting common stock. There are some nuances. You can have non-voting common, but in essence is one share is equal to one share, which is equal to one share. Every share is treated alike. There's no difference in the rights, the preferences, or privileges of that stock. So what ends up happening in an S corporation, say you and I are 50% owners, we have to share the income, the losses, 50% pro rata. Distributions have to be pro rata 50%. So you can see it's very rigid, but it does give that benefit of flow through. Contrast that with a C corporation. C corporation again has the double taxation. For example, if a corporation has $100,000 in net income, it will pay tax on that $100,000. The net of that, assuming that's all distributed to the shareholders will then pick that income up as income and pay tax on that again. And out of $100,000, you would know the calculation better than I would, but they're not going to get very much compared with an S corporation. The distribution would be free from tax at the entity level. A C corporation also has more flexibility in the type of shareholder. You can have a corporation, a partnership, an LLC, an individual, a trust be a shareholder of a C corporation.
Yep.
It's very unlimited. It's unlimited in the number of shareholders as well. As we know the daily names of Hewlett Packard, Cisco, Intel, those are C corporations, and they have thousands and thousands and thousands of shareholders. So those are really just kind of the overarching differences of the two entities.
Yeah. Okay, so again, well, one thing, an S corporation, usually, I guess you could just say, it's a more closely held type of an entity. A C corporation, it can be very broadly held. And again, the restriction in the shareholders. So for example, you can't have a foreign person as an investor in an S corporation.
That's right.
And that's a very key thing these days when we've got so much international investment that's going on. So, so that was a big restriction for S corporations. Another thing, though, is the type of property. What do you want in these corporations? So, and we may talk about more later, I don't know, but just in case, depending on time getting away from us, sure. Generally, we don't want to have real estate inside of a corporation. It's just a horrible asset to have in a corporation. And yet, at one time, it was popular to have real estate in corporations. So you'll find some very old corporations that had real estate in them.
And then they go through and make the election and wait the 10 years.
Yeah. But even then, it's very messy to have it in an S corporation because you can't really get it out. And you mentioned how easy it is to set these up. So a lot of these entities, one of the things is that they're fairly easy to set up, but a C corporation is one of the hardest ones to get out of. And so, so that's something to be aware of. is easy to set up, but not necessarily so easy to get out.
Right. So, for example, maybe I think what you're saying, I expand on that. I think is that if you have highly appreciated assets in a corporation, even in an S corporation,
yes,
it's going to be, in those assets are distributed to the shareholders. It's going to be deemed a sale, and it's going to be taxed. Whereas maybe we'll talk maybe in a partnership structure, we have more flexibility. It may not be taxed because there's a the shareholder, the partner has a basis, and the distribution to the shareholder, I'm really mixing this up for everybody. The assets that are highly appreciated in a partnership
yes,
may not be taxable possibly to the partner depending on that partner's basis.
yes.
Whereas in a C&S corporation, you're definitely going to get hit with that.
Yeah. So if you distribute property out of a corporation, an S corporation or a C corporation, if you actually distribute that property, that is a taxable transaction. It's treated as if you had sold it in a sense and then paid a dividend or whatever. Whereas from a partnership, you can distribute property and it can actually just take the basis, the investment, if you will, from the ownership interest itself. And so that's a very distinct difference, and it's a very important one, and it's also though very complex, and I've just really oversimplified it, but it is a big advantage, again, of partnership type structures over corporate structures. Well, let's move on a little bit because we've got other entities to talk about, and time is going to get away from us for sure. So, but another one, a form that has become very popular recently is the limited liability company. So can you explain a little bit about what a limited liability company is and why they've become so popular?
Yes.